The deal is already sold before the risk is understood. Clients sit across conference tables, hearing words like balance, diversification, smart engineering. They believe the bank standing in front of them is aligned with their interest. What they do not hear is who helped choose the assets. They do not hear that someone on the other side is betting on collapse. Inside Goldman Sachs, a synthetic mortgage product called Abacus is assembled as the housing market starts to tremble. Emails move fast. Decisions are made quietly. A powerful hedge fund wants exposure not to win, but to lose, and it wants a hand on the wheel. When the bonds begin to fail, money moves in opposite directions. Losses pile up for investors who thought the structure was neutral. Gains land with the party that expected the crash. By the time regulators step in, the question is no longer about complexity. It is about disclosure, intent, and whether selling a product while betting against it crosses a line the system was never built to police. Chapter 1. The product that should not fail. The conference rooms were clean and quiet, glass walls, soft chairs, coffee poured without being asked. Clients were told this was a sophisticated product built for uncertain times, a way to manage exposure as the housing market kept climbing. It was presented as smart risk distribution, not a gamble. Inside Goldman Sachs, the product had a name that sounded abstract and safe, Abacus 2007 AC1, a synthetic collateralized debt obligation. No physical mortgages, no houses changing hands, just references to mortgage bonds bundled and rebundled, then sliced into tranches with different levels of risk. To clients, the pitch was controlled complexity, exposure without ownership, diversification across multiple mortgage-backed securities, independent selection of assets by a third party. The bank was clear about one thing. This was not a bet on housing prices rising forever. It was positioned as a balanced instrument that could perform across scenarios. What was not part of the pitch was the pressure inside the bank. By early 2007, warning signs were no longer subtle. Subprime mortgage delinquencies were rising. Adjustable rate resets were hitting borrowers who could not refinance. Internal market desks were tracking the data in real time. Stress was visible in credit default swap spreads tied to housing. The signals were there, even if the broader market had not fully accepted them. Within Goldman, different divisions were seeing different futures. The structured products group focused on building and selling deals. The trading desks watched volatility creep in. Risk teams ran models that showed increased downside exposure. None of this was illegal. It was how large financial institutions worked. But it created a fault line between what was being sold and what was being understood internally. Abacus was designed to sit on that fault line. The product did not own mortgage bonds. It referenced them. That meant investors were effectively taking a position on whether those bonds would perform. If the bonds paid out, investors would earn returns. If they failed, investors would absorb losses. On the other side of the trade, someone would profit from that failure. Clients were told that the reference portfolio was selected by an experienced third-party manager. This detail mattered. It implied neutrality. It implied that the assets were chosen based on standard credit criteria, not on a directional view of collapse. In complex products, trust often rests on process rather than comprehension. Sales materials emphasize structure, not motive. The pitch books described tranche hierarchy. Senior tranches were safer. Equity tranches absorbed first losses. Models showed expected default rates based on historical data. The language was technical but reassuring. It suggested rigor. It suggested discipline. Clients asked questions, but not the one that would later dominate headlines. Who chose the assets and why? At the time, the question did not feel urgent. Housing had slowed, but it had not yet fallen apart. Many institutional investors believed stress would be contained. They had lived through scares before. Long-term capital management, the dot-com bust. Each time markets adjusted, this felt similar, a correction, not a collapse. Inside Goldman, emails reflected a different tone. Traders discussed increasing fragility in mortgage-backed securities. They noted how quickly sentiment could shift. Some desks reduced exposure. Others looked for ways to hedge. There was no single view, but there was awareness that the environment was changing. Abacus moved forward anyway. The structure itself was not unusual. Synthetic collateralized debt obligations had existed for years. They allowed investors to gain exposure without holding assets. They were efficient, flexible, and profitable. Fees were earned up front. Risk was transferred. Everyone, on paper, knew what side they were on. But complexity has a way of blurring responsibility. Goldman acted as the structuring bank. It assembled the deal, marketed it, and facilitated the transactions. It did not take a long position in Abacus. It did not promise performance. It framed its role as intermediary, matching parties with different views of the market. That framing would later become central to its defense. At the time, it allowed sales teams to speak confidently without feeling deceptive. They believed the disclosures were sufficient. The offering documents were dense, hundreds of pages. Risks were listed, loss scenarios described. The assumption was that sophisticated investors understood what they were buying. What those documents did not make explicit was the influence behind the asset selection. The reference portfolio included mortgage bonds tied to subprime loans. Many were already showing weakness. This was not hidden information. Ratings agencies still graded many of them as investment grade, but cracks were forming. Delinquencies were rising in specific regions. Loan quality was uneven. Clients saw mix. They saw diversity across issuers and vintages. What they did not see was intent. From the outside, Abacus looked like a neutral mirror of the market. From the inside, it was increasingly clear that the mirror might be angled. Sales calls continued, meetings happened, the product closed. Investors took positions believing they were entering a balanced trade. Some believed housing would stabilize. Others believed diversification would protect them from concentrated losses. Few believed they were stepping into a structure designed to magnify failure. Goldman earned fees for structuring and marketing the deal. That was standard. It was disclosed. It was expected. What was not discussed openly was how much internal confidence remained in the long side of housing-linked products. By the time Abacus was live, defaults were accelerating. The market moved faster than most models predicted. Bonds in the reference portfolio began to deteriorate. Losses started to materialize. For investors, the damage felt sudden. Performance reports turned negative. Questions followed. Why these bonds? Why this mix? Why now? Inside the bank, the answers existed, but they were fragmented across desks, emails, and time zones. No one moment defined intent. There was no single meeting where deception was planned. What existed instead was a system that allowed conflicting incentives to coexist without forcing clarity. Structured finance rewarded deal flow. Trading rewarded foresight. Risk management flagged exposure but did not stop transactions. Compliance focused on documentation, not moral alignment. Abacus slipped through that space. As losses mounted, attention shifted, not just to the market collapse, but to how the deal had been built. Investors revisited disclosures. Regulators began asking questions. Journalists started pulling threads. The question that emerged was simple and dangerous. If the product was supposed to be neutral, why did it feel so perfectly positioned to fail? Chapter 1 ends here with a product already in motion, losses beginning to surface, and a growing gap between what clients believed they had bought and what the structure was actually designed to do. The deal did not look criminal. Not yet. But the ground beneath it was already giving way. Chapter 2, The Hidden Hand. The hedge fund did not come in quietly, but it did not announce itself either. It arrived through meetings, calls, and proposals framed as market insight. By early 2007, Paulson & Company was convinced the housing market was not just overheated, but structurally broken. Subprime mortgages, in its view, were already failing. The only question was timing. John Paulson wanted a way to bet against that failure at scale. Goldman Sachs was one of the banks positioned to help. Synthetic products made it possible. Credit default swaps allowed an investor to profit if referenced mortgage bonds collapsed. The mechanics were legal, common even. What mattered was how those mechanics were used. Paulson's proposal was direct. Build a synthetic collateralized debt solution tied to subprime mortgage bonds that he believed were weak. He would take the short side. He would pay premiums. If the bonds failed, he would collect. That part was not controversial. The controversial part came next. Paulson wanted influence over which mortgage bonds went into the reference portfolio. From his perspective, this made sense. He had done the research. He believed certain bonds were more likely to default. If he was paying to insure against failure, he wanted exposure to the worst risks. That was how conviction trades worked. Inside Goldman, discussions followed. Allowing a short investor to help select assets was not explicitly illegal. Synthetic deals were negotiated instruments. Counterparties often expressed preferences. The key question was disclosure. Who needed to know and how much? The reference portfolio for Abacus was supposed to be selected by an independent third-party manager. That detail reassured long investors. It suggested neutrality. It suggested that the assets were chosen without a built-in bias toward collapse. In practice, Paulson's input mattered. Emails later made public showed that Paulson and his team reviewed lists of potential mortgage bonds. They pushed for inclusion of securities they believed were especially fragile. Bonds backed by subprime loans issued in overheated markets, loans with high loan-to-value ratios, borrowers with limited documentation. The third-party manager retained formal authority, but the direction was clear. Paulson's views shaped the pool. None of this was disclosed to the investors taking the long side. They were not told that the party betting against them had helped choose the assets they were betting on. They were not told that the structure reflected a deliberate negative view of housing. They believed they were entering a balanced trade, not one tilted toward failure. As the deal closed, the housing market continued to deteriorate. By mid-2007, cracks turned into fractures. Subprime lenders collapsed. Bear Stearns hedge funds tied to mortgage securities failed. Liquidity dried up. Prices fell fast. The bonds referenced in Abacus followed the trend. Defaults rose. Ratings agencies began downgrading securities that had been considered safe only months earlier. The reference portfolio deteriorated with alarming speed. For Paulson and Company, the trade worked exactly as planned. As mortgage bonds failed, the value of the short position surged. Premiums paid earlier turned into massive payouts. The firm made billions betting against housing across multiple structures. Abacus was one piece of that strategy. For long investors, the experience was the opposite. Losses mounted quickly. Reports showed declining values. Tranches that were supposed to be protected began absorbing damage. The speed of the collapse caught many off guard. Diversification did not help when the entire sector moved together. Questions followed. Why did these bonds fail so quickly? Why were so many weak securities concentrated in one structure? Why did the product perform worse than expected under stress scenarios? As those questions circulated, information began to surface. Some investors learned, informally at first, that Paulson had been on the other side of the trade. That fact alone was not shocking. Every trade had two sides. What unsettled them was the possibility that Paulson had influenced asset selection. If true, it meant the game had not been neutral. Internal Goldman communications captured the tension. Emails showed awareness that Paulson's role was sensitive. Some employees debated how much needed to be disclosed. Others focused on the fact that offering documents listed risks broadly. They believed that sophisticated investors bore responsibility for understanding them. The distinction between legal sufficiency and ethical clarity widened. Goldman maintained that it had acted as an intermediary. It matched willing counterparties. It disclosed material risks. It did not take a directional position. It did not guarantee outcomes. That defense rested on a narrow interpretation of duty. Regulators would later focus on a different question. Was the omission of Paulson's role in asset selection misleading? By late 2007, the answer was no longer academic. The financial system was unraveling. Losses spread beyond subprime. Banks wrote down billions. Trust evaporated. Products once sold as innovative became symbols of excess. Abacus became one of those symbols. Investigators began reconstructing the deal. They reviewed emails, pitch books, and term sheets. They traced how the reference portfolio was assembled. They examined what was said to investors and what was not. What emerged was not a simple story of fraud. It was a story of selective transparency. Paulson's influence had been real. His negative view had shaped the structure. Investors on the long side had not been told that the portfolio reflected the preferences of someone betting on collapse. That gap became the center of the case. For Goldman, the risk shifted from market loss to reputational and regulatory exposure. The firm had survived market turmoil before. This was different. This was about trust. The deal had been legal on paper. But legality was no longer the only standard being applied. As losses hardened into realized damage, regulators prepared to act. The question was no longer whether the product failed. It had. The question was whether the way it was built crossed a line that disclosure rules were meant to protect. Chapter 2 ends here, with the hidden hand exposed. the market in free fall, and the focus turning from collapsing bonds to the decisions that placed them together. The trade that had been invisible to clients was now impossible to ignore, and the consequences were moving from spreadsheets into enforcement files. Chapter 3. Exposure, Enforcement, and Cost. By the time regulators moved in, the damage was already done. The market had collapsed. Trillions in value were gone. Banks were fighting for survival. Public anger had settled into something colder and more dangerous: accountability. The Abacus deal did not cause the financial crisis, but it fit the moment perfectly. It was complex, opaque, and profitable for insiders while investors absorbed losses. It became a symbol, not of one bad trade, but of a system that seemed to reward precision deception. The investigation began quietly. Requests for documents, emails, internal memoranda, term sheets, marketing materials. What regulators wanted was not market hindsight. They wanted intent, disclosure, and responsibility. The focus landed on Goldman Sachs. Investigators reconstructed the timeline. Who proposed the deal? Who selected the assets? Who approved the disclosures? They compared what was said internally with what was presented to investors. The contrast mattered. Internal communications showed awareness that Paulson and Company had a strong negative view of housing. They showed that Paulson had influence over asset selection. They showed concern about how sensitive that role might appear if exposed. What they did not show was an explicit admission of wrongdoing. That distinction defined the case. Goldman's defense was consistent. The firm acted as an intermediary. It matched counterparties with opposing views. It disclosed risks in the offering documents. It did not have a duty to align interests. It did not take a long position in Abacus. It did not promise success. From a narrow legal standpoint, those arguments carried weight. But regulators were not focused on promises. They were focused on omissions. The question became simple and precise. Would a reasonable investor have considered it important to know that the party betting against the deal helped choose the assets? The answer in the eyes of regulators was yes. The U.S. Securities and Exchange Commission prepared its case carefully. It did not allege that Goldman caused the crisis. It did not allege that synthetic products were illegal. It alleged that marketing materials were misleading because they failed to disclose a material conflict. Specifically, the SEC argued that investors were led to believe the reference portfolio was selected independently, when in fact it reflected the preferences of a short investor with a vested interest in failure. That omission, regulators said, crossed the line. Goldman pushed back. It argued that the offering documents were clear that investors could lose money. It argued that sophisticated institutions did not need hand-holding. It argued that no rule explicitly required disclosure of a short counterparty's role in asset selection. Both sides were right in different ways. That was the problem. As the case moved forward, public pressure grew. The financial crisis had left scars that were still fresh. Bailouts had saved institutions but damaged trust. The Abacus case offered something rare, a narrative that could be understood. A bank sold a product, another investor helped design it to fail. Clients were not told. In April 2010, the SEC filed its civil complaint. The allegations were serious but restrained. No criminal charges, no accusations of market manipulation, just one core claim: material misrepresentation. Markets reacted immediately. Goldman's stock fell. Headlines spread. Congressional hearings followed. Executives were called to testify. Language became sharper. Words like integrity and ethics replaced yield and tranche. Behind closed doors, negotiations began. Goldman faced a choice: fight the case in court or settle. A court battle carried risk. Discovery would expose more internal communications. Testimony would extend the story. A loss could be devastating. A win might still damage the firm's reputation. Settlement offered certainty. In July 2010, Goldman Sachs agreed to settle with the SEC for $550 million. At the time, it was the largest penalty ever paid by a Wall Street firm. The settlement mattered for what it included and what it did not. Goldman did not admit or deny wrongdoing. That language was standard, but the firm agreed to pay the penalty and to reform its disclosure practices. It acknowledged that the marketing materials had been incomplete. For regulators, the settlement sent a message. Disclosure mattered. Process mattered. Complexity was not a shield. For investors, the outcome was mixed. The penalty did not restore losses. It did not reverse damage, but it validated a grievance. It confirmed that something had been wrong even if it had not been criminal. For the broader financial system, the Abacus case became a reference point. Banks adjusted how they described conflicts, disclosure language expanded, compliance departments gained influence. Synthetic products did not disappear, but scrutiny increased. The industry learned a careful lesson. You could structure almost anything, but you had to be explicit about who stood where. The cost to Goldman went beyond the fine. The firm absorbed reputational damage. It faced public criticism. It became shorthand in debates about Wall Street ethics. For a company built on credibility, that mattered. Inside the firm, the case triggered internal reviews. Policies were revised. Training changed. The line between intermediary and participant was examined more closely, but no reform erased the central tension. Financial markets are built on opposing views. Every trade has a winner and a loser. The system depends on disagreement. What Abacus exposed was not that disagreement existed, but that its architecture had become invisible to those who trusted the structure. The final cost of the deal could not be measured only in dollars. It lived in the erosion of confidence, in the sense that complexity had been used not just to manage risk, but to obscure intent. The Abacus case did not end the era of structured finance. It did not bring down Goldman Sachs. It did something quieter. It forced a question into the open. When disclosure meets complexity, who carries the burden of clarity? Chapter 3 ends with that question unresolved. The settlement closed the case, but it did not close the debate. The deal was over. The money was paid. The rules were adjusted. Trust once strained was slower to return.